Bonds and Their Valuation, Chapter 7, Finance 355, with Diana Temsky from the University of Wisconsin, La Crosse. So what is a bond and what are some bonds? A bond is a long-term debt contract under which a borrower, i.e. the issuer, agrees to make payments of interest and principal on specific dates to the holders of the bond, the investors. So a bond is a debt. The issuer is the borrower, the party that issues the bond. The investor is the bond holder. The payments that the bond issuer agrees to make, the interest payments that is, are typically made semi-annually, and we call them coupon payments. So some types of bonds. You're a little familiar with treasury bonds because that's what we've been looking at and computing interest rates quite a bit in the last chapter. Treasury bonds include those bonds issued by our federal government, supposedly have no default risk. Our federal government has not defaulted on any of its bond payments, which is a good thing. So we say they do not have default risk. There are different types of treasury bonds. There are T-notes, T-bills, and T-bonds. You can read a little bit about those specifics in your textbook. Some more types of bonds. There are corporate bonds, those issued by corporations. There are municipal bonds or munis. You already know a little bit about those. And there's foreign bonds, bonds that are issued by foreign governments and foreign companies. Read about these a little more in your textbook. I just give you the bare bones definition right here. And some more types of bonds: mortgage bonds, debentures, subordinated debentures, investment grade bonds, junk bonds. Make sure you read about these in your textbook as well, because I don't even give you a definition for them here. I include them to make sure I tell you to read about them in your textbook. So bond markets, where are these things traded? Bonds are traded in the over-the-counter / OTC market and the New York Stock Exchange. Most bonds are owned by and traded amongst large financial institutions. So think the institutional investor there is the primary agent in bond trading. Full information on bond trades is not as easy to find as full information on stock trades. Stocks are very easy to find information on. You can do that quickly within seconds. On Yahoo Finance, Google Finance, whatever it is, whatever tool you want to use on the internet, you can find information on any publicly traded company and their stock. Bonds, not so much. It's much more difficult to get quotes and relevant information. You have to really search for it. It's not as readily available. The New York Stock Exchange does list kind of a representative listing of bond information, and the Wall Street Journal does as well. Otherwise, it's important to note to you that it's not as easily obtainable as stock quote information. Key features of a bond. I'm going to hit on all of this information up front here, and then we'll talk about it and go more in depth on these features when we calculate valuation problems. But I want to cover the features here for you in these next few minutes so you can get a sense of what is inherent to every bond issue particularly. First of all, the par value. The par value we refer to as the face amount. It's the amount that the bond will be worth, at maturity. For corporate bonds in America, we can always assume 1,000. So when we calculate bond valuation, that will be our future value. The value of the bond at maturity is the par value, and we're going to assume $1,000 because that is most typical with corporate U.S. bonds. Your textbook author includes examples that involve different par values. A note about my mindset: since most U.S. corporate bonds are issued in increments of $1,000 face values, that is my mindset on quizzes and exams and assignments. Anything to do with bonds from me, you can count on the future value being 1,000. So many problems on quizzes, exams, or assignments might be missing that information. Know that you'll have to pull it from your own personal memory bank, and it will be relevant to all bonds that you compute for me. Coupon interest rates. I noted to you with the bond definition that bonds pay periodic interest payments. Most corporate, if not all, U.S. corporate bonds pay interest payments semi-annually to their investors. This coupon interest rate is a stated interest rate within the bond contract. We multiply par value by the coupon interest rate to get the dollars of interest that will be paid to the investor periodically for the coupon payments. Maturity, the years until the bond must be repaid. When we compute bond valuation problems, maturity will be necessary for our computations, but remember N is in periods. And so if we're looking at maturity in years and a bond pays coupon payments semi-annually, which most do, then you're going to have to reflect that in your calculations. And I'll walk you through that, don't worry, but just some side notes to give you a background here. Some other key features of bonds that are important to us: the selling price. What is the investor paying for this thing? We'll denote that as the present value when we compute bond value problems. The issue date, it may be important in the problems you look at, but certainly important in the investment world, the date when the bond was issued. Default risk is very important as just a conceptual underlying background theme when we look at bonds and bond yields and bond prices. The default risk, just a refresher, is the risk that the issuer will not make interest or principal payments. It's that chance that the issuer, the borrower, might not make their promised payments to the investor. So we build default risk in our free market economy into bond yields and prices. So just some background information for you. One other key feature or characteristic to bonds worth mentioning is the yield to maturity. I'll denote that frequently as YTM. The yield to maturity is the rate of return earned on a bond held by the investor until maturity. And when we compute bond valuation problems, that will be our I/Y key on our calculators. Yield to maturity is also referred to as the promised yield to the investor. It's that yield the investor can expect to see over time if they hold the bond until it is mature. Evaluating default risk and bond ratings. Default risk is one way to rate, probably one of the most important ways in the marketplace that bonds are rated. There are different ratings companies that provide these ratings. There's a table similar to this in your textbook. And there's only two ratings companies included here on this table, Moody's and S&P. There's a third major ratings company. It's called Fitch. Fitch's ratings follow the exact same system as S&P's ratings do, meaning the letter system, the AAA, AA. This is kind of a bare bones table, if you will. It doesn't include all the nuances that go along with the ratings. For example, S&P offers a plus and minus system with their ratings. So there's AA, but there's also AA plus and AA minus. There's also single A plus and single A minus, so on and so forth. One of the important things to remember is that there's a division at some point with all three companies, and it's along the same lines, so it's kind of equivalent to where we look at investment grade bonds versus junk bonds. Investment grade bonds, there's a nice divider in the table for you there, include capital B, double A, and better for Moody's, and for S&P and Fitch, triple B and better, all the way up to AAA for S&P and Fitch. Junk bonds are anything below that. What's the big deal? Well, the big deal is that these ratings, these default risk ratings, help establish and work towards establishing the percentage as far as the interest rate, the yield to maturity that the borrower is going to end up paying the investor on these bonds. So consider what you learned with interest rates, and we added in this default risk premium. this is it. This is where it essentially is established in the marketplace based on, in part, by these rating companies and what they establish as the default risk rating for a given company, country, etc. for their bonds. You're going to read about some examples in your current events rating this week, so it'll help kind of put it together for you to make a little more sense of it, if you will. Include this slide here, this other bond definition slide, primarily for your benefit and just to make note or reference to it. Current yield we'll look at in some problems and another screencast that you'll be viewing this week, and in the problems that you'll do, of course. Capital gains yield and expected total return. I'm not going to work through examples of those. There are some in your textbook. We'll be doing plenty of yield to maturity calculations, which is essentially the same as expected total return. But I include these definitions for you as they are equations that I include on your equation sheet for this chapter, and just to make sure I draw your attention to them. The last three slides here in this screencast, call provision and sinking fund provisions, I include just as I would in a face-to-face class. I include them just as definitional note slides. I don't typically talk about them. I just encourage you to read about them in the textbook. I prefer to spend my time working through problems and illustrating concepts that way. So take a look at these. These are here just for your notes, and that'll wrap it up for this screencast.